Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Welcome to Passive Real Estate Investing with Mavericks, where we provide actionable steps to grow your passive income and become job optional. During this episode, you're going to understand and discover how to find a better lender and why it matters. What are the nuances of it? Hey, for those of you who are new, welcome. I'm your host, Neil Timmins. I love passive income from real estate. Before I introduce you to today's Maverick, I want to make a request that if any point you like what you're hearing, give us a thumbs up and subscribe to never miss a show. And if you love what you hear, give us a written review. Plus, be sure to take a look at the description of this episode as we packed it with thousands of dollars in free resources. Today, we've got the privilege to learn from a person with a 30-plus year career in lending, who is a connector, a broker, if you will, between borrowers and the insurance industry. And at his point in his career, he got introduced to lending at a very young age. I would describe this Maverick as somebody who's passionate about making sure that borrowers put themselves in the absolute best position for longevity and success. And at the end of the day, it means more money to their passive investors. Today's Maverick, Michael Balan. I'm excited to have him here. Michael, how are you?
I'm great. How are you?
Good. Thank you. And I appreciate you taking the time to connect up. This is going to be a fun conversation because I find it to be very timely. Now, you and I connected and talked for just a couple of seconds before we went live. So for the audience's benefit, who are you? Where are you from? And what do you do?
I am originally from New York. I'm a mortgage banker. I'm a lender that uses capital from 24 life companies to make commercial real estate loans anywhere in the country, any size, on just about any property type that is a multi-tenant commercial property and or a credit single tenant property.
Okay, great. Now there is a lot of things taking place on the debt side in exactly the space you do, and I think I've never seen an environment where on the bank level, regional banks, smaller banks, where the spreads are so different among banks, among lenders. What are you seeing out there? And then I'm going to take it a step further. What should people be doing, or what should they know about the environment that we're living and operating in today?
Okay, so look at a year ago, 2 years ago, rates were very low. It was easy to make deals work. Very competitive environment. Most people had almost all their cash in the bank, which was kind of the fuel that makes a bank go as it relates to lending. They lend out other depositors' money. When the treasury market ticked up, all that liquidity ran out of the banks into the treasury market, making it very much harder for banks to make loans because they had less dollars to lend. At the same time, interest rates shot up, and they have a portfolio of very low rate interest rate loans, and now all of a sudden they're looking at refinancing those low interest rate loans at probably double the interest rate. So they've got to be very careful with the loans they have, and they have less capital to lend. So that makes for almost, very tightened credit environment.
One of the things that you do is you deal with a lot of life companies, and they are different from a lending sense in banks in many regards. What are just a few of those regards in which they are different?
Well, the main difference is that if you have a life insurance policy, you understand that they don't pay you anything on your premium until something happens. Either you pass away or you sell the policy or what have you. So their cost of funds is essentially zero. They're investing dollars that they're not paying somebody interest on. So it doesn't matter how much liquidity you leave in there. They have to invest the money so that at the end of your policy, it pays off. Whereas a bank has to continue to attract deposits so they can lend out money, make a return on that, and then give it back to you whenever you want it. So one of the problems you're seeing now is that some of these banks made longer term investments and aren't ready to satisfy the redemptions that people are calling for. It's a dangerous position for a bank to be in, but a life company is never in that position because they're more like a stock. They use an investment portfolio. So they'll invest in stock, in bonds, in equity, and in real estate loans. Typically, it's about 10 to 15% of their investable capital is in real estate loans that they hire people like us to make. So the main difference is they're not lending capital that somebody could show up and say, "I want my capital back."
Yeah, and have a run on a bank, and all of a sudden, like what we've seen in a handful of hours inside of a day, the bank is in a jeopardized position.
Yeah, there's also they're not subject to the same regulations, whereas a bank is regulated by the OCC. Mm-hmm. The insurance companies are not regulated that way.
Yeah. I'm going to assume this, and I'm going to ask, fair to say that there's probably a minimum threshold for a dollar amount. A life insurance company is going to want to place bigger dollars than what a bank would typically do in a particular loan. Is that fair to say?
In general, but there are small life companies that can do loans going down to $1 million, $750,000 on up, and then they'll have a maximum of say $8 or $10 million. And there are some life companies that won't do a loan that's below $50 million.
Run of the mill on average, you draw the line in the sand and go, this is about where one would be before you look at this as an avenue.
If I'm looking at the loan myself, I'd say $3 million would be the lowest, and I would only do that for someone who had a portfolio of loans or there was some other relationship tied to it. Otherwise, we have younger originators that focus on those kind of things.
Here's where I'm going with this. Once in a while, I hear that sometimes bigger seems scarier, and there's more risk that one takes on with a bigger deal. And the point I want to make here is that it may not be the case, because if you can pass a certain threshold, additional lending opportunities become available that you may not get at a smaller threshold that provide more stability, more security to an overall investment.
The number of zeros, I agree with you. The number of zeros isn't the critical part. So a $50 million loan versus a $5 million loan will have a different universe of lenders. So oftentimes I'll see two deals like that, and someone will say, you were very competitive on the $50 million deal and you were not as competitive on the $5 million deal. And it's not because the lenders penalize the smaller deal. It's because there are less lenders. And the smaller lenders are less competitive.
Yep. No, that makes total sense.
But there's also people that look at these investments and say, or loans and say, it's a $5 million loan. Is it worth the effort? There's not enough return in it, the same amount of risk. So it's just a mentality.
So I hear all sorts of things from people I talk to, and I know it varies from lender to lender. And I end up talking to a lot of banks, small and regional banks. And for some of these people, they're going, "Hey, we're tapped out. We don't have any more money to lend. We're not going out we're not going out and originating new things at this point in time. We're trying to raise deposits because we're concerned about what's taking place." And I suspect the life companies, that's not the case. They're probably flush of cash and want to actively compete for quality loans.
Yes, absolutely. So, there's two things happening with the local small and regional banks is that one, as you mentioned, their deposit base kind of moved into the treasury and the stock market, and they're having problems with acquiring enough cash to make loans. And also their view of what's coming is, difficulty with renewals and much higher interest rates, rents at the property level tapering off and or being reduced, and insurance costs making it harder, more difficult to operate. So they're being much more conservative, much more careful, limiting their dollars primarily to existing clients, not looking for new relationships. Life companies, on the other hand, last year, they were having a phenomenal year, first half of the year. Middle of the year, rates went up, a big spike in rates, and it basically stopped. The music stopped. So at the MBA conference this year, consistently all of them said, we want to make up for last year, and we want to increase our allocation for next year. So they have a much bigger war chest to spend, to invest, to lend, and they're asking us to help them find more loans.
When underwriting a loan, are there some nuances, some differences relative to, a bank, if you will, versus a life company, or are all the kind of the inner workings of it very similar?
No, it's completely different. Life companies are cash flow lenders, and they don't view personal recourse, the ability to go after an investor if they stop making payments because the property failed. So we're very focused on historical cash flow with life companies, whereas banks will typically look at all kinds of other considerations, how much net worth and liquidity a borrower has as a guarantor, what their global cash flow looks like, the upside in the future, where are rents going? Are they adding tenants? Are they making improvements to the property that'll bring in more cash flow? Whereas a life company is typically looking back and saying, hey, look, this is a pretty steady horse. Over the last 3 years, it's been very consistent, and we are betting that it's going to go forward in a similar fashion, but they're lending less because they have no recourse, because they're relying on the cash flow. If something goes wrong with that life company deal, they just want to sell the property, get as much as they can, and move on.
Loan to value, typical, what's it look like?
It'll go up to about 75%.
Coverage ratios at what number?
Very similar, 125.
Yeah.
But again, they're a bit more conservative. So in some of these larger MSAs, if you bring them a 4 cap deal, they may look at it and size it with a 5 cap or a 5.5 cap. But if they do that, they'll go a bit higher on the LTV.
On the LTV. Yep.
Yeah.
So you talk to a lot of, syndicators, a lot of people who would go raise funds from investors. Mm-hmm. Where do you see the syndicators, the general partner, I'm using that word interchangeably, where do you see them get it really, really right when it comes to their lending? And where do you see guys get it wrong? And I'm asking this question because I know we've had a number of passive investors, and maybe this is one to put in the back of their minds so that when they're interviewing and connecting with general partners, that they can ask these types of questions relative to how a general partner goes out and borrows money. So the general partner, what are they doing that get it right? And what are the guys doing who get it wrong? What actions are they taking? I
think transparency is always key. There are syndicators that hire people and are, reporting on a quarterly basis and very detailed. They're making investments that they would only make, the same kind of investments they would only make with their own money, but bringing in other investors kind of into the opportunity so they could do more deals. And then I think on the flip side, there are some syndicators that act like institutional investors who are investing other people's money. So they're a bit more, looking for take on more risk because there's a lot of fees in it and there's more upside. And it's other people's money. And that's my perspective. They don't say that to me. But it feels like they're lending other people's money, so they're taking on a bit more risk, looking at a bit more pro forma, being a bit more, forward-looking in these value-add deals, because that's typically what I see as value-add deals from these syndicators. And I think that if it was their own money without any investors, they possibly would either offer less or move on to another investment.
Interesting.
So I think they take a bit more risk, and I don't know if that's. I wouldn't say that I'm being critical of that. That may be what the investors want.
No doubt about it. It's important to understand what that looks like, understand thyself, and make sure that you align with, an investor, an operator who is perfectly fit for you.
Yeah. And I would ask the question, it's depending on what your interest is. If you really want to go fast and make as much as you can and bet the house, I wouldn't ask the question. But if that's not you, I would just simply ask the question. If this wasn't my money, this was your mother's money, or it'd be rude about it, but your family's money or your money, and it was all of your money, would you be buying this? And let them answer you as to why. I mean, there's plenty of deals out there where I think that's the case.
Yeah. What are you most excited about for this year?
This kind of market becomes more complicated, and I think for people who have experience, it's not unusual, and it's there's a greater need for people like us.
Yeah.
Whereas over the last 10, 15 years, anyone could do it. When there's that much competition, it's harder to stand out and to get paid properly, and there's a lot more noise.
Sounds like the more complex and the more challenging the environment is, the more probably one has to use their brain to be able to structure and put things together and make it make sense to come up to create solutions.
Yeah, you've got to be creative. I mean, I see a lot of people right now who are living in the past, still thinking that rates are going to go back to 3.5%, still thinking that cap rates are not going to go up and they're going to continue going down. Rents will keep going up. So for the other people who are ready to act, you need to be careful about the way you do it.
But you said something that just triggered a thought. I have seen a lot of people, put packages together, and they are really betting hard on the fact that in multifamily, I'll give you an example, that rents are going to raise by 7% to 9% every year for the next 5 years, and then we're going to sell this thing. We're going to be at a similar cap as to what we are today or what we were a year ago, and this is where we're going to make. This is how we're going to make all our money. When you get a package like that, and you got some pretty aggressive rent rate increases on a forward-looking basis, how are you evaluating that? How then is the lender evaluating that?
Well, the lender's backing out those increases and not trending rents or flattening out rents. I feel bad for the value add guys who are, implementing proven rental increases by adding value. I think those are very legitimate rental increases, and they have proof that they've been occurring. And I think the lenders will discount those, and they get kind of caught up in the wash with, just the increases that we've seen over the last couple of years on a year-over-year basis. The projections for higher rents are great, but we really can't underwrite them for purpose of sizing a loan. Because again, what I'm looking at is, how does it affect us getting to that 125 debt service coverage? And if I get to more, that's better for the investors. That's playing around with their return. It's not playing around with my loan.
Yeah. So what I hear you saying is that gets neutralized, and you size a loan in such a way that is on a backward looking basis. What's actually happening right now? What are they actually achieving for cash flow today? And we're not gonna bet on the future as a lender about what might happen to the rental increases moving forward.
Yeah, but it will seep into the decision. Do I make this loan because it should do better in the future?
Sure.
It's not a negative that somebody is, their personal opinion is that rents are going to continue to go up, because we see it.
No doubt.
If you're improving a property and people need a place to live, and it's a better place to live than the alternative, rents will be going up in markets where the general trend is either flat or, going down. That, we will see vacancy again. We will see concessions. But that doesn't mean, the vacancy and collection factor in most markets is traditionally higher than it is now.
No doubt.
To go to 5% or 6% in a market, no one should be looking at me saying that's so doom and gloom. It's never going to happen. But it's a product of what happens. We're building new product, we're renovating old product. So, but there's also a lot of people moving around.
Correct. Yeah. There is a tendency to mean revert, right? To fall to the average or rise to the average, depending on where you happen to be in any given situation.
Yeah. And we're here in Florida, especially in South and Central Florida. There's a lot of people moving here. And there's a lot of people moving here that are used to paying more rent. Yep. So for anyone to say that's ridiculous, your rents are not going to go up at this particular property, and we're not going to give any credit for that in our underwriting, that really depends on where it is. Overall, in the multifamily verse, there may be places, zip codes, where rents are going down, rents are flattening, concessions are going up, but that isn't going to be an across the board event.
No, market specific.
Yeah, and I would imagine in California and New York, Chicago, Detroit, Baltimore, things like that, where people are not dying to move there, you'll see some of that. It usually falls within a historically manageable mean.
Yeah. Let's do this. I want to move on to the final segment, what I call the final four. What do you think holds most investors back, active or passive, doesn't matter, from hitting their personal next level?
Obviously fear of losing on an investment, probably a pretty big one. What I think helps some investors, reach success is that they don't overanalyze everything. that whole analysis, paralysis by analysis thing. I mean, you'll never be out of data in order to talk yourself out of making an investment. And the data will never be ideal as it relates to jumping in and making the investment. So you've got to find the right balance. And I think the person who looks at enough deals that they can find the right deals without being undisciplined, I think will, move along nicely and put together a nice portfolio of investments for themselves. And the person who has a hard time pulling the trigger needs to just find a solution. They need to either bring in someone to help them do due diligence and, bounce off their ideas and kind of push through the hesitancy or what's causing them to not move forward. Because a lot of times I look at deals from a lending perspective and I say, well, I couldn't get that deal done, but it got done and it ended up great. So all my lenders are wrong and my borrower wasn't wrong.
Right.
So I think from the investor perspective, it's the same way. I didn't get in with those guys and look, they made a 35% return. Well, you can't, I wouldn't waste any time or a lot of time on that, but certainly go back and look at it. What did those guys have that I didn't have? Why did that? It's really about understanding yourself.
What are you passionate about outside of real estate?
Passionate about? I mean, my hobbies include, NFL football. I'm a Chicago Bears fan. I don't watch college football because I can only get one day. I can get Sunday. I can't get Saturday and Sunday.
Yeah.
I love the NFL. Go to games, watch games. Sunday ticket. I watch all the games. Bourbon. I'm a big bourbon collector, hunter. I don't drink. I barely drink anything else besides bourbon. Blues music. I love rock and roll and blues music. Because of the shutdown and the pandemic, all the concerts got canceled. And then all of a sudden there was a flurry of, all these rockers, from the 70s and 80s and 90s that toured. So it was literally like every other week concerts, Chili Peppers, Green Day, it was, the Stones. It was just any concert. We just went.
Yeah.
Because again, we were locked down for a year.
Exactly. Pent up.
All of a sudden, it was, it was crowded. We stood in front. People were yelling and screaming. So if we were going to get COVID, that was the place to get it. I have my boys. I got 2 teenage boys. I'm supposed to give a shout out to Max this time. I was on Josh Wilson's podcast, and I gave a shout out to my son Eli. So if you don't mind, my son Max, I'm very proud of. He's graduating from FSU in a couple of weeks.
Wonderful.
Yeah. And my dog. German Shepherd.
German Shepherd?
Mm-hmm.
Big dog. We used to.
Big dog.
We had one years ago. What a great breed.
Yeah. Very, very intense.
What's your favorite way to make a impact in the community?
We did a lot of community service with the Police Athletic League. My son was a Boy Scout, so I was a Boy Scout leader. And as a troop, we did a lot of community service. So that's, just being active. Yeah. And we live in a beach community, so there's always beach cleanups. The PAL is great at helping underserved communities and creating a better relationship with the police, things like that.
That's terrific. For people who want to find you, they want to connect with you, they want to follow you, where should they go? What should they do?
LinkedIn. Look at my profile. I have a newsletter that I send out once a month, so I'm always sensitive to not just throwing people on there because they don't want to get the what could be perceived as junk mail. So get my newsletter, email me, or go on LinkedIn and I can send it to you. Our website, tdwood.com. That's where you can see what we do. I also happen to have a note sale business. That's the other passion of mine now, is I started a note sale business.
Oh, tell me a little about the note sale business. What type of underlying debt?
So we sell commercial loans for banks, life insurance companies, and debt funds and private investors.
Typical.
And historically, it's kind of a better mousetrap story. There, the process that a lender uses to dispose of a non-performing note is very chaotic. And as a 30-year veteran, a friend of mine is also 30 years in lending and workouts. We just understand how to underwrite a loan, understand what a bank is looking for, or a life company is looking for, and can plug in directly very discreetly the highest bidder. Without going to an auction, the public has no idea you've sold a note. So if you're an investor and you're trying to get a loan from a bank, you'd probably avoid the bank that's selling notes.
Yeah.
Because it doesn't sound like they're going to be very aggressive on making a new loan.
No, as soon as a bank goes in and has to sell anything, they tend to pull back pretty quick.
Yeah, and I don't want to be making a affirmative statement that a bank that's selling notes isn't making loans as well, because those do exist. But just in general, if you want to find an aggressive bank, chances are they're not in the process of making loans and selling loans at the same time. I would agree with that statement. Yeah, it's just something different. When my boys moved out, I was an empty nester. I had more time, and instead of I'm not near retirement age, so instead of slowing down, I'm speeding up. You got to find something else to do to just keep you busy. Yeah, well, I'm trying to pull people out of the past, into the present, the new rate environment with, trying to. It really, the biggest question I have is what are these people doing? They missed the bottom of the market as it relates to rates. They didn't refinance a year and a half ago when rates were nothing. Cap rates went to, almost 3%. They didn't sell. So what's the plan? TREP has indicated there's $2.3 trillion in mortgages coming due between this year and 2027. Mm-hmm. And to your point, I just wanted to piggyback on your point. There's a lot of people who just didn't do anything, and there's a lot that's coming back, and it's going to have to be dealt with. You're in that space. Right. So the one thing you have to own if you're that investor is you're not good at timing the market. So stop trying to time the market and, make the best of what's available. And if you have a property that has enough cash flow, you can get a loan that accommodates your need to potentially sell, even though you've been saying that for 10 years. Oh, that big sale is coming, and it did come, but you didn't take it. So you can get some prepayment flexibility. You can get a duration that allows you to take advantage of rates go down, or you could sell, and maybe you don't get the same amount of equity out of the sale that you would have gotten 2 years ago or a year ago, but a lot of these people still have a lot of equity. What they're going to invest in if they want to do a 1031, those opportunities I think will start showing up. I think there'll be a lot of activity. I couldn't agree with you more. But we have a segment. There's a segment of the population, as I just mentioned, they're going to be forced with the decision to make in some capacity. It is going to be refinance, and that may mean write a check to keep the property. It's going to be sell the property, or in some cases, it's going to mean the lender's taking the property. Yeah, the two things that I would say is I would talk to people like myself who have an understanding of the capital markets, and I would avoid hiring multiple people because that's just going to end badly. But the one caveat I would say for your investors who are LP investors is I would look towards development, investing in development if you really want to get a larger return than everybody else is getting, but have the ability to take on more risk. Because right now, it takes a long time to get to update costs. Costs may be going up. Rents may or may not be going down, but the IRR certainly could come down, but they're so big. To have a 28, 35, 40% IRR, you could still afford to, walk away with a 25% return, but not for everyone. If it's capital that you need, I would stick to cash flowing properties. Yep. I would agree with exactly what you just said. Yeah. Michael, this is a fun conversation. I knew I would get a lot of this, and I'm certain the audience has as well, because there's some significant differences between bank lending and life lending, what it is that you do. Yes. And we're in a changing environment, but it's not just interest rates that have changed. The dynamics in which life companies lend and their underlying cost of capital is different. And when interest rates are near zero, it's hard to see those differences. And when interest rates are, the 5-year treasury doubles in a year, which it's never done in the history of the 5-year treasury, like it did in 22, you see those differences play out. Yeah, well said. The one thing I would ask, and maybe this or I'd notice, is that no matter what I post on LinkedIn, you get very little conversation. Maybe it's what I'm posting. But that's what I would recommend is for people to ask the questions. If you have, don't feel ashamed because you're asking a question that other people may already know the answer to. If you see me make a post or someone like myself, an economist, the Red Shoe Economist is great. We're all here to give you simple answers because there is a pretty simple plan. You don't have, people complicate things. But either you do or you don't have the cash flow for a particular kind of deal. If you don't have the cash flow for a permanent deal, you may be on the way to getting it, so you have a bridge deal. If you don't have either, you're probably a seller. And don't go out and take a 12 or 13%, a hard money loan because you're going to be even worse off in a year if nothing, spectacular happens. So it's not rocket science. It's, there's principles to it. It's just not everybody knows them because everything was so easy for so long.
It's you're right about that. You're spot on about that. Well, all the links that you had referenced, Michael, and the website and all the details you just said are below in the show notes for everybody. Mm-hmm. Michael, I appreciate your time. Thank you so much for being here.
Thank you for having me, and thank you for the great questions.
You bet. Till next time.
Appreciate it.
To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.